Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first dollar plunges 1.6% as NY Fed's surprise move signals joint intervention with Japan, threatening the massive yen carry trade. We'll analyse why this potential shift in US dollar policy matters now and how the unwinding of the yen carry trade could threaten global market stability. Second, EU and India near a historic trade deal to counter China, but a new EU carbon tax threatens to negate benefits for key Indian industries. Today, we'll take a closer look at this clash between traditional free trade and climate protectionism and its implications for global supply chain realignment. Third, Trump threatens a 100% tariff on Canada over China ties while seizing 50 million barrels of Venezuelan oil, setting a new precedent for sovereign asset risk. We'll examine how these twin threats challenge international law and may impact the stability of North American supply chains and global energy markets. The most unexpected news in the finance world today has to be this. The New York Federal Reserve just made a surprise move on behalf of the US Treasury, and it sent currency markets into a tailspin. For years, the US has maintained a so-called strong dollar policy. The idea was simple. A strong dollar helps keep inflation in check by making imports cheaper and attracts foreign investment. But this move by the NY Fed might signal a subtle pivot. It suggests a growing concern that the dollar has become times 2 times strong, hurting American exports and creating instability. A source confirmed the NY Fed conducted what are known as rate checks on the dollar-yen pair. This isn't just routine paperwork, It's a well-known tactic where monetary authorities ask dealers for live pricing, signaling they are gauging conditions for a major market move, essentially a warning shot fired across the bow. History gives us a clear precedent here. The last time the US and Japan teamed up for a major intervention like this was back in 1998 during the Asian financial crisis. Back then, the yen was also incredibly weak, and their joint action marked a major turning point. The fact that they are signaling a similar move now suggests the situation could be just as serious. And the market reacted instantly. The dollar, which had been relentlessly strong, plummeted from around 157.50 yen to a 4-week low of 155.66. That's a massive 1.6% drop in a single afternoon, triggered by this single action. Now, get this, the sharp drop was fueled by the fear of an unwind in what's known as the yen carry trade. For years, because Japan has had near zero interest rates, global investors have borrowed yen for cheap and invested that money in high-yielding assets around the world, like US stocks. A potential intervention to strengthen the yen threatens to blow this whole trade up. A stronger yen means those investors would have to pay back their loans with more expensive currency, forcing them to sell other assets quickly to buy yen, which can cause turbulence across global markets. What really brought this to a head was the unusual nature of who was involved. Analysts are pointing out that US authorities stepping into what was seen as a Japanese issue is highly unusual. For weeks, traders have been watching the yen approach the critical threshold of 160 per dollar, a line many believe would trigger intervention from Japan alone. Coordinated action is a much more powerful tool than a single country going it alone. After all, the last truly massive coordinated effort to manage exchange rates was the famous Plaza Accord in 1985, when the world's major economies agreed to devalue the US dollar. These events are rare and can reshape financial markets for years. So now the game has changed. The NY Fed's move is being interpreted as a clear signal that the US and Japan may be preparing for joint intervention. This isn't just about one country defending its currency. It's about two of the world's largest economic powers potentially joining forces to draw a line in the sand. Interestingly enough, this isn't just about the dollar and the yen. A successful intervention to strengthen the yen has direct implications for China's currency, the yuan. A stronger yen makes Japanese exports more expensive, which in turn makes Chinese goods more competitive. This could put pressure on the People's Bank of China to guide the yuan weaker to maintain its own export competitiveness, potentially reigniting currency tensions with the US. So the most immediate takeaway is that a ceiling may have been put on the US dollar's strength for now. The threat of intervention alone is a powerful deterrent. All eyes are now on the Bank of Japan for official data that could confirm if this was just a signal or the start of a coordinated campaign. This information is for informational purposes only and is not investment advice. Currency markets are highly volatile. All financial figures are based on reporting at the time of broadcast. Speaking of major economic powers joining forces, another massive partnership is taking shape that could redraw the global trade map. India and the European Union are on the brink of finalising what officials are calling the mother of all deals. After nearly 2 decades of negotiations, they're pushing to create a unified free market of 2 billion people, accounting for a staggering 1/4 of global GDP. This isn't just a trade pact, it's a strategic realignment on a massive scale. What we're actually witnessing is the rise of a geopolitical hedging premium in global trade. The thinking is that future trade partnerships are no longer being valued on pure economic efficiency alone. Instead, countries are prioritizing supply chain resilience and strategic alignment with geopolitical allies. This EU-India deal is a prime example of this shift, showing how the world is fragmenting into economic blocks built on trust, not just cost. So, why the sudden urgency? Well, India is looking for reliable partners to offset the impact of 50% US tariffs. At the same time, the EU is urgently trying to reduce its trade dependence on a China that one analyst calls unreliable. According to the Economist Intelligence Unit, the urge to partner is now equally strong on both sides. This strategy has a name, friend shoring. It's the deliberate rerouting of supply chains away from perceived rivals and towards allied nations. And the EU-India deal is the biggest test of this concept yet. Analysts are even tracking a friend shoring index, which has shown a significant uptick as negotiators have already finalised 5 key chapters of the agreement. For China, the implication is direct. This is a politically driven effort to divert trade and investment to India. For India, whose economy is on track to cross $4 trillion this year, the deal would restore critical market access to its largest trading partner, and the impact could be immediate. The agreement could trigger a rapid snapback in competitiveness for certain Indian industries. For example, sectors like textiles and garments, which lost their preferential tariff benefits in the EU just last year, would instantly regain that advantage. But that's not the whole picture. Even as this deal slashes traditional tariffs, a new kind of trade barrier is emerging, the EU's Carbon Border Adjustment Mechanism, or CBAM. Think of it as a carbon tax on imported goods. This means that even with a free trade deal, Indian exports like steel and aluminum could face new costs of up to 22% to enter the EU, effectively negating some of the FTA's benefits. The situation presents a fascinating duality. On one side, a historic free trade agreement designed to bring economies closer, while on the other, it exposes a new front where climate policy is becoming a powerful tool of trade protectionism. The key things to watch are the final negotiations on the remaining chapters and, crucially, how the EU decides to implement the CBAM rules for its new free trade partner. In the markets, this could boost the Indian rupee in certain stocks, but that carbon tax will hang over Indian steel and aluminum producers. We were just talking about the complex new rules shaping global trade, but now let's turn to a story where the old rules are being thrown out the window entirely. A 100% tariff on all Canadian goods. That's the stunning threat just issued by Donald Trump, aimed squarely at one of America's largest trading partners. The trigger? Any potential trade deal between Canada and China? Trump didn't mince words, stating on social media that if the deal goes through, the tariff would be immediate. His warning was stark, claiming, quote, China will eat Canada alive, completely devour it, including the destruction of their businesses, social fabric, and general way of life. This is where the situation takes a more complex turn. The threat marks a potential shift towards what some analysts are calling a secondary tariff model. Traditionally, tariffs are placed on goods from a rival country, but a secondary tariff targets an ally for doing business with that rival. This is significant because the US and Canada are part of the USMCA Trade Pact, which has its own rules for resolving disputes. By threatening a blanket tariff, the US is bypassing those established rules and subordinating the treaty to discretionary action. This could force a costly fragmentation of the highly integrated North American supply chains, especially in sectors like automotive and lumber, driving up costs for consumers. But that trade ultimatum is only half the story. In a separate and equally explosive declaration, Trump announced the US has taken oil from seized Venezuelan tankers. The number is staggering, 50 million barrels. His direct words on the move were simply, quote, "We take the oil." He confirmed this crude is now being processed in American refineries in places like Houston. The shift from financial sanctions to direct physical seizure sets a dangerous new precedent for what's called sovereign asset risk. It signals that a country's physical assets, like an oil tanker on the high seas, can be taken. Believe it or not, this could lead to a spike in global maritime insurance costs and even invite retaliatory seizures of American corporate assets abroad. This isn't just a one-time seizure. The move is part of a larger, stated ambition for the US to control Venezuela's oil resources indefinitely, with a long-term vision of a $100 billion plan to rebuild the nation's oil industry under US direction. Actions like this will likely intensify the drive toward alternative trading blocks that reduce exposure to US policy shocks. Now, you might be thinking that adding 50 million barrels of oil to the market would cause prices to crash. It's more complicated than that. This acts as an unconventional supply injection. Unlike a predictable release from the Strategic Petroleum Reserve, this introduces a huge amount of geopolitical uncertainty. In the short term, yes, it could cap oil prices, but in the long run, this kind of unpredictable action could disrupt OPEC plus supply management and deter private investment in energy production, fearing their assets could be next. From a trade war threat that could paralyze commerce at the northern border to the direct seizure of a sovereign nation's primary resource, these actions signal a dramatic and aggressive shift in policy. They challenge the established rules of global trade and international law. The key things to watch now are whether Canada proceeds with its China deal and how other oil-producing nations react to the seizure of sovereign assets, and whether other allies accelerate efforts to route around US pressure, as we've been tracking.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.